A massive public infrastructure project is operating at full capacity. Dozens of machines are moving earth, hundreds of workers are on site, and then, suddenly, everything shuts down. The contractor awarded this job won a lucrative public tender. The project was priced correctly, the margins were healthy, and the work was proceeding on schedule. Yet their headquarters is now locked and abandoned. A structural flaw in how the construction industry measures time can bankrupt a firm, regardless of its technical skill or estimation accuracy. A project that appears wealthy on paper can simultaneously destroy the company building it in reality. When a government or developer commissions new infrastructure, they rarely provide the contractor with the upfront capital required to build it. Instead, the contractor mobilizes their own resources. They pay weekly labor wages out of pocket, they lease heavy equipment and purchase tons of raw steel and concrete before a single invoice is approved.
In practice, the construction company operates as a massive, interest-free bank. They are financing the developer's infrastructure using their own private liquidity. Because cash goes out immediately while revenue is delayed, the total profit margin is practically irrelevant in the short term. Surviving construction requires managing the exact timing of incoming cash. To recover their massive out-of-pocket expenses, contractors rely on a milestone system. An external quantity surveyor visits the site to evaluate the physical progress of the build. When the surveyor confirms a specific milestone is hit, such as 20% completion, it triggers the creation of a formal progress certificate, allowing the contractor to issue an invoice. This document legally converts months of physical labor and poured concrete into a recognized financial asset on the company's books. This is the moment the trap is set. The company recorded revenue, but that money remains entirely theoretical. Physical cash hasn't entered their bank account. The moment the invoice is generated, the tax authority is alerted. This introduces a strict legal concept known as the time of supply. This page from the SARS Value-Added Tax Guide defines the rules for progressive construction supplies. The law dictates the tax clock starts ticking at the earliest of 3 dates: when payment is due, when received, or the moment the invoice is issued. By issuing the invoice to claim their money, the contractor triggers an immediate tax liability. The government demands its VAT cut by the 25th, even if the client hasn't paid the invoice. Example 7 illustrates the math. After self-financing the early stages, Jay's Construction issues progress invoices for January and February. By doing so, they instantly owe the state over 84,000 Rand for January and another 110,000 Rand for February. The state initiates a rigid countdown for 200,000 Rand in cash the contractor does not possess. Meanwhile, the approved invoice enters bureaucratic limbo. It sits on a desk, waiting for a final signature. Days turn into weeks. The expected payment date is continually pushed further into the future by administrative processing. The rigid tax deadline strikes the 25th of the month, while the client's payment remains frozen in administration. To avoid severe legal penalties, the contractor must drain their own emergency cash reserves to pay the VAT bill on money they haven't received. They pay their labor force, they pay for materials, and they pay the state. Eventually, the cash reserves hit absolute zero. The contractor is forced to buy time with their own liquidity, effectively subsidizing the developer's administrative delays. Even if a contractor completes the build, the final handover still doesn't result in full payment. Standard contracts include retention money. The developer holds back 5 to 10% of the total project value for 12 to 24 months to cover potential defects. This 5 to 10% withholding typically accounts for a contractor's entire net profit margin. Depending on how the final certificates were structured, the tax authority may have already taxed the contractor on this locked-away amount. A contractor can complete a flawless project and settle every tax bill on time, only to be starved of capital for their next job. This crisis stems from incompatible realities contractors must balance: the tax ledger and the bank account. The tax ledger is governed by the legal principle of entitlement to payment. On paper, it creates a reality where the company appears wealthy. The bank account is anchored to physical cash flow, which is continually depleted by the tax demands of that ghost ledger. The legal definition of earning money is dangerously out of sync with the physical reality of possessing cash. On a macro level, the burden of bridging this gap is crushing the companies tasked with building infrastructure.
For the business owner, it means executing the work perfectly, delivering the project on time, and still losing the company to insolvency. They did not run out of profitable work. They ran out of the cash required to wait for their own money. Taxation and delayed payments operate on different timelines. Until they align, profitable companies will continue to disappear.